Hi, good morning, everyone, and thank you for joining us for this timely discussion on navigating a market correction, especially in light of recent developments in Indian equity market. The benchmark Nifty 50 has witnessed a decline of nearly 18% from its peak. We've seen FIIs pull out nearly $10 billion plus in recent months, signaling shifting global risk appetite. While all of us here know that markets are cyclical and corrections are a natural part of investing, the volatility we've seen in recent months has left many investors with a lot of questions on their portfolio. So, how should you, as investors, respond? Should you hold, rebalance, or seek new opportunities? How should you look at your portfolio? That's exactly what we will dive into with our expert here. On this note, let us welcome Vaibhav Porwal, our co founder and head of investments at Dezerv. Hi, welcome, Vaibhav.
Hi, Hardik. Good morning and a warm welcome to everyone who joined this Saturday morning. Last 2 months have been tough, and it's important that we have this conversation to understand what triggered these corrections and what is the outlook for the market going ahead.
Great. Vaibhav, as you pointed out, last few months have been tough. Typically as the clock strikes 9:15 a.m., our portfolio bleeds red across the board. Your reaction to that first?
Obviously, correction has been sharp, and some of this was anticipated. We have been talking about high valuations in the market, but we are also surprised with the extent of correction. The correction has hit different segments of the market differently. Most of the correction impact is felt by direct equity investors. Large cap index has remained much better compared to other segments of the market. When you look at the overall correction, mid and small caps have corrected much higher compared to large caps. And then other segments, when we look at direct equity investing, direct equity stocks have fallen substantially more compared to mutual funds or indices. One segment which obviously is missing here is PMSs, and PMSs have also seen sharp correction. So that is also something that we should talk about later in the webinar. Now, some of the reasons for these corrections have been building up. So if you look at the data, you can divide this in two parts. First, a significant up move in the market over last 24 months has resulted into excessive valuations, especially in mid and small cap segment of the market. And unfortunately, earning growth has disappointed. So because of that disappointment in the earning growth, these valuations became unsustainable, and which resulted in this sharp correction. On the other hand, what we experienced was aggressive selling by FIs, and that this is something that a lot of investors have asked us about, why FIs are selling. So two reasons for that. First, aggressive trade policy by Trump administration, so which has resulted into sharp depreciation of rupee. Along with that, sustainably high interest rates in US has made it very difficult to FIs to take risk in any emerging market. And India being one of the emerging markets also saw these kind of withdrawals. Last 6 months, FIs have pulled out almost 1,50,000 crores worth of equity allocation from Indian equity market. So which is a large part of the selling in the market. And these two factors have primarily contributed to this correction in the market. Extent of correction is different for different segment depending on where the excessive valuations were there. If you look at this chart, mid and small caps in the month of September had started trading at 30 to 40% premium compared to their historical average valuations. And on the left hand side, when you look at the earning growth, that did not support these kind of valuations. So these are some of the factors which contributed to this correction.
Fair, Vaibhav. So what I hear from you is while the correction is widespread, there is different degree of pain in different segments. And
Absolutely.
we'll obviously try and cover in detail some of the data points pertaining to what could potentially be outcome in each of these categories. Uh, Most of the selling is on account of FI net selling. You mentioned clearly there are global and domestic reasons for selling pressure in the market. Now let's get to the more pertinent question, Weber, which is why most of the audience is here. What should we as investors be doing in such a market? What we've tried to do is actually compile a list of a few questions we thought we should address in the course of the conversation today. And I'll start with the first question, which is essentially, did you anticipate this steeper decline in the market, right? We'll cover some of the next questions over the course of the conversation. But Weber, for the first question, did you anticipate such a steep decline in the market?
So I think every time we invest in equity market, we work with an assumption that markets can correct by 10 to 15% anytime. And this is based on historical data. Every other year, you'll see a fall of 10 to 15% in the market. And obviously, these corrections are part of the longer term journey of the market and they keep happening in the market. Good thing about some of these corrections is it also presents an opportunity to buy equity at lower valuations. And if you look at the historical data, and this table below represents the data perfectly, the probability of generating high returns in the subsequent period goes up substantially. So when we look at this data and anyone who invested after a period of sharp drawdown in the market, your returns over next 3 years are likely to be 15% plus across categories. So which is the silver lining in every correction. Reasons for corrections are different every time, but 10 to 15% correction is normal for the market and we experience it many times in the journey.
Weber, what we understand from this chart, essentially, what we are trying to say is that there's been a drawdown, double-digit drawdown. In fact, even steeper declines over the last 20 years in almost every year or every subsequent year. But every recovery typically would be led by some positive triggers. Uh, what do you think could potentially be positive triggers from here on for the market to start on the recovery journey?
So absolutely, Hardik. So as I said, drawdown is a good time to invest in the market because the subsequent period returns are very high. And right now, there are multiple positive triggers which are there in the market. Having said that, it doesn't mean that short-term risks are not there. But from a long-term perspective, triggers are extremely positive. Two triggers that we are looking at very closely is first, revival of consumption. Last 3 4 years, we have seen slowdown in consumption, and most of the market returns came because of government-led capex. But we are seeing early signs of consumption recovery, and which is supported by both RBI and government actions. So if you look at the data, RBI started embarking on monetary policy easing. That means we can expect lower interest rates going ahead, which should support consumption in the economy. Along with that, government has also given a large tax relief in this budget. The total amount of tax relief is about 1 lakh crores. And this 1 lakh crore going back into economy by way of consumption will ensure that our growth numbers come back on significantly higher trajectory. The other factor which we are looking at very closely is health of the balance sheets. Both government balance sheet as well as bank balance sheets are extremely healthy today. Government deficit, which is the difference between the revenue that government makes and the expenses that government incurs, is going down sharply. From the COVID high of 9.2%, we are down to 4.4%, which means government can pump in more liquidity in the economy if needed to augment the growth. Banks are also sitting on a very healthy balance sheet with NPS consistently declining. They also have adequate buffer in terms of capital to inject liquidity in the system to ensure that growth remains elevated for us. So these are some of the positive factors that we are looking at. Along with that, obviously, valuations have become reasonably attractive after these corrections, and that also presents an opportunity for the investors to invest from 3 to 5 years perspective.
Fair point, Weber. What I hear from you essentially is that the government balance sheet is improving, corporate balance sheet is improving, bank NPAs are on a decline. There is more money in the hands of people now with the tax reliefs that the budget has provided. Weber, a couple of things just to make it easier for our audience to understand. The chart on the top left, right, where we are suggesting easy monetary policy ahead. Can you elaborate further? Are we suggesting the interest rates could decline? Is this the RBI monetary policy that we are talking about?
So interest rate, Hardik, has a positive impact on consumption in the economy. Lower interest rates mean people can borrow money at lower interest rates and have lower EMI burden. So when you go and buy a home, if interest rates are higher, your home loan EMI will be much higher. With lower interest rates, you will be able to borrow money at lower interest rates, and therefore your EMI will be much lower. This motivates consumers to go out and spend more money because their overall EMI burden will go down. We saw a prolonged period of high interest rate environment in the economy because inflation remained sticky. but there is reasonably good evidence that inflation is going down. All the inflation numbers, both consumer inflation as well as wholesale inflation, has started going down. So, which has given a lot of elbow room to RBI to start easing interest rates. And that will make sure that consumers are able to borrow money at lower rates, and that will kickstart the consumption uptick in the economy.
Got it. Great, Vaibhav. So clearly there are positive triggers going forward which could lead to recovery, but you did mention, and I want you to elaborate on that, where you said there could be short-term risks, because longer-term prospects obviously seem positive. What potentially could be the short-term risks from here?
See, short-term risk can be divided in two parts. First, sentiment-led risk. So markets can overextend on either side. So if you remember last year, we were at similar Nifty levels, 22,500, 23,000. That time sentiment was extremely positive, and market in some sense overextended on the upside, and Nifty went up to almost 26,200. The same thing plays out on the downside also. So right now sentiment is negative, and that can create some selling pressure in the market. But honestly, that is very difficult to predict. Along with that, if trade policy uncertainty remains for some more time, that will create some pressure on the market. But these events keep playing out in the market. Sitting today, when I look at the valuations for next 3 years, there is a clear opportunity for investors to invest in equity market and make great returns.
Where
These are short-term risks and which may or may not play out. I don't know whether they will play out or not. These are the risks which are there. But from the long-term perspective, opportunity is way too good to uh, pass.
Fair. I think one question that I've got, and for the benefit of the audience, will clarify. Drawdowns essentially mean decline from the peak, which means if market was at X level, it's moved to Y level. The decline from X to Y is what we call drawdown. Moving on, Weber, last 5 years at least, we've seen a lot of people being very bullish on the India story, especially for small and mid caps. With a smaller base, they felt that they have a larger room for growth, and they preferred small and mid caps over the large cap stocks. They played it through mutual funds and through PMSs. Uh, and for the longest time, it seemed like the party was going to last forever, right? Until it did not. What is your view here on? Should we foresee different behavior, different outcome for small and mid caps going forward?
So there's a bit of a misconception around small and mid caps versus large cap. There is a general belief that small and mid caps always do better than large caps. Over a very long period of time, small and mid caps do better than large caps, but there are two factors which are important to understand. First, the entry valuation of mid and small cap. It's important that you buy these companies when valuations are attractive. And second, you have to make sure that you are buying these companies when earning growth momentum is strong for these companies. Last 3 4 years there has been a bit of a recency bias, and as you can see in this chart, investors have invested 3 to 4x of large cap amounts in mid and small cap category, which happened because of this perception which got created after COVID, that the difference in returns between large cap, mid cap, and small cap is very large. But if you look at the historical data and break the period before COVID, you will see the difference in return was negligible. In fact, large caps did much better compared to mid and small cap if you look at the data before COVID. Only after COVID, mid and small caps delivered much higher returns compared to large caps. So, which means that there is a little bit of recency bias which has played its role here. I strongly believe that portfolio has place for all three categories, and investors should be vigilant about the valuations and earning growth of each segment before deciding to allocate money in any of these segments. There is no default rule to say that the mid and small caps will always, regardless, give higher returns compared to large caps. So that's how I see this opportunity today. Honestly, if you ask me, large caps are fairly attractive. If you look at the valuations of large cap index, yeah, one additional point is small and mid caps can take much longer to recover compared to large caps. So we have seen in the past that every time there is a large correction, the days to recovery in case of small and mid cap is much longer compared to large caps. So that is also something that we need to be mindful of. Now, yeah, sorry.
So if we were to read
Yeah,
the chart,
so building on the
sorry.
same point, I was saying that when I look at the markets today, and if I don't apply the default of saying that I have to invest in mid and small cap and look at data and see where the opportunity lies, large caps are much better positioned compared to mid and small caps. In this chart, it is evident that valuations of large caps are lower than where they have traded historically. And if you look at longer period also, go back in time and look at data for 15 years. One surprising data is that price growth of the index is lower than the earning growth of the company in case of large cap. So that means last 15 years, all the returns in the index has come because of earning growth. There is no change in the P which has taken place over this period. So, which makes a strong case that you need to be overweight on large cap instead of being overweight on mid and small cap as a default choice. I think it is super important for us to realize that in the end game, what matters the most is your entry valuation. It's not the category in which you invest.
Fair point, Weber. Few takeaways that I gather from whatever you've shown so far is one, the fact that look at where the relative valuation of each category is. While the fact that market is governed by GDP growth and that the earnings growth would follow GDP growth and eventually stocks should deliver that kind of return. What matters is your entry valuation because for the longest time you could perhaps make subnormal returns. And here you see that there is better value perhaps in large caps today compared to small and mid caps. The other key takeaway, which was in the previous slide where you mentioned road to recovery for small cap from steep drawdowns is significantly longer compared to large caps. Just for the benefit of the audience, essentially what we are trying to say is for the small cap index to come back to the same level as the peak, it could potentially take what 540 days on an average to recover from the peak. Is that the understanding correct?
Yeah, absolutely. So I'll simplify it further. If small caps correct by 20% and large caps correct by 20%, recovery in large cap will be much faster compared to recovery in small caps. So it makes it difficult for investors to stay invested. When you're seeing large caps are recovering faster, there is a tendency to move away from small cap and move towards large cap.
Great. Moving on, Weber. How about selecting individual stocks and investing in direct equities? Now, there are always exceptional stock stories, right? That we hear from people saying the kind of returns they generated in individual stocks. What is your opinion on direct investments in stocks?
So I've seen investing for last 22 years and 98% clients have underperformed the benchmark and mutual funds when they invest in direct equity. Honestly, last 3 4 years, the tendency to invest in large cap amongst investors has gone up because of some of the strong narratives that we like and some of the strong stories that we like. The issue in India, and it's particularly relevant for India, is the percentage of investors who invest directly in stock market compared to going through professional investors is much higher compared to any other developed market. So if you look at US, 80% of individual investor investing in equity market happens through mutual funds or professional fund managers. In India, the ratio is very different. So this has costed us dearly in the past also. We looked at data of 2008 period. In 2008, when we analyzed the data of 1,000 companies, one interesting data point that came out was 25% of these companies ceased to exist. So after 15 years, when we look at the data, 25% of these companies don't even exist today. So which is a large number. uh, or don't exist or have lost money for the investor. Sorry, it's not just not existing or lost money even after 17 years of time. Another 20% companies have delivered less than FD returns for the investors. So we are talking about almost 45% of the universe not delivering returns or losing capital for the investor. Direct equity investing requires professional expertise and time allocation. So it's very difficult for an individual investors to dedicate time to go through all the balance sheets, understand financials, understand the market movement of these stocks and take a call. We have been strongly against unsupervised direct equity investing. This, based on our experience and the data that we have seen, 98% of the investors lose money in this process. There are enough companies and good examples. Some of these were fairly large companies which cease to exist today. So these are some of the examples that we have tried to cover. So the company on your left hand side was a large consumer electronics goods company which went bankrupt, which was a 20,000 crore market cap company in 2008, but today it doesn't exist. Another company which was one of India's leading construction and infra company that has gone bust over last 15 years. So many such examples which are there. Therefore, direct equity investing requires a lot of professional expertise. The amount of mistakes that you can make in direct equity is fairly large. So our recommendation is, as far as possible, one should avoid direct equity investing.
Fair. So enough and more examples, and obviously the statistics from the 2008 cycle obviously suggests that the odds of being successful depend on a lot of factors while you're investing in direct equities. Weber, from here on for investors, what should the expectations be in the equity market in terms of returns?
So we always said that long-term equity market returns in India will be equal to nominal GDP growth plus 100 200 basis. And there are 2 points here. A, it is long term, it plays out in long term. And B, the returns will be closer to nominal GDP growth plus 100 to 200 basis. This data summarizes the point very clearly. If you invest for a period of 10 years, there is not even a single instance of losing money in equity market. Whereas if you invest for a short period of time, the likelihood of losing money is as high as 30%. So which means that you need to invest money in equity market for a long period of time. Once you invest money in equity market for a long period of time, your expectation of return should be very close to what the earning growth of the companies is. Then earning growth of the companies have a large correlation with GDP growth of the economy. So these factors put together, our sense is that expectation of returns should be between 13 to 15% in Indian equity market going ahead. Now, 13 to 15 seem small relative to 25-30% that we have gotten used to over last 3-4 years. But over a long period of time, this 15% number is a very powerful number. So if someone invests 100 rupees today and stays invested for 20 years, at 15%, 100 rupees would become 1600 rupees. So that's a 16x return over a period of 20 years. It's a large number. And that's how most of the investors who have been able to stay invested in the market have been able to create wealth. So it's important to remember that your return expectation should be between 13 to 15%. Returns will be in line with what the earning growth of the companies is, underlying companies is, and that will get influenced by how GDP growth is there in the economy.
A couple of key takeaways for me here, Vaibhav, especially when you say 16x growth in 20 years, a 50 lakh check could sort of become 8 crore rupees. And that's massive wealth creation over any other asset class. One thing, Vaibhav, if you could clarify for our users is you mentioned that return expectation should be 100, 200 basis points over and above the nominal GDP growth. If you could simplify nominal GDP growth for the users.
See, nominal GDP growth is country's GDP growth plus inflation. So if India's GDP growth, and yesterday number was 6.2%, and expectation for this full year is 6.5% GDP growth. If we add an inflation number of 4 to 4.5% to that, we are talking about country growing at 10.5, 11% for the full year. So that is country's top line growth, if I can use that word. Our total economic product for the year for India as a country has grown at 11%. So that is the top line growth. Bottom line growth, which is a profitability growth, is typically slightly higher compared to that. So we should expect 100 to 200 basis higher returns compared to that in the broader market. And on top of that, you have active management, which adds another 100 to 200 basis, which has a potential to add another 100 to 200 basis in your returns. So that's how you can break down your 15% return. GDP growth, which is top line growth, then bottom line growth, where some efficiency should come, and then active fund management, which can add another 100 to 200 basis to your overall returns. Now, one other question which keeps coming is why in India the correlation between GDP growth and market return is very high. And there are many other economies where it has not played out like this. The reason for which it plays out much better in India is the composition of our market. The sectoral composition of our market is very similar to our GDP composition. 50 to 60% of our market sectoral consumption, sectoral composition represents services sector by way of banking and ID. So representative nature of our index make sure that we have high correlation with GDP growth.
Fantastic. I think this is quite clear. Uh, Whether all said and done for the long term, investors could stay invested. In the shorter run, of course, drawdowns are a little scary. In terms of asset allocation, then would you suggest that investors should sort of look at it differently? If not fully deployed in equities, and even if in the past, of course, most users were very close to 100% deployed in equities, even incremental liquidity was being pushed to equities. Should investors think differently now? What are the adjustments that you think they should make to their portfolios?
I think 2 points are there here. First is you mentioned stay invested. The key is your ability to stay invested in a volatile market. If you are able to stay invested for a long period of time, you'll be able to realize the returns. If you are not able to stay invested, you won't be able to realize your returns. So if you're not comfortable with ups and downs in the market, and in the short term, ups and downs in the markets can be fairly large, especially in case of direct equity stocks. Last week, we saw this example of a large company announcing capex in wires and cables of $200 million. As a result of that, already listed companies saw a correction to the extent of $3.5 billion of market cap. So that's the nature of equity investing. In short term, the movement can be fairly large, and if you are not able to stay invested during the course of these corrections, it becomes very difficult. So asset allocation for me is something which will make your journey easier and smoother, will help you stay invested for a long period of time. If you are able to create an asset allocation which allows you to sleep peacefully at night without having to react to every market event, then you should go for a balanced asset allocation. In my experience, I've seen investors choosing to have a balanced allocation across asset classes doing much better over a long period of time versus investors who get in and get out of equity market because they want to take an aggressive approach of investing only in equity.
Vaibhav, could you elaborate a little bit on the chart here? Uh,
Yeah, so what we are trying to say here is there are various types of various degree of drops which are possible in the market. So between 5 to 10%, 10 to 15%, 15 to 20%, and greater than 20%. So if you invest only in equity, the likelihood of seeing more than 20% drop in the portfolio value in the interim is 3.1%. So every uh, investor will face this drawdown much often compared to investing in a blended asset allocation of 30% equity, 30% debt, and 10% gold. If you invest in that combination, then the likelihood of drawdown of more than 20% drops to only 1%. So there is a substantial difference between the two. So by drawdown, as Hardik explained, the drop in value in the portfolio from the peak value. So if you invest 100 rupees, the portfolio value going down to 80 rupees means you're experiencing a drawdown of 20% in the portfolio. So in a asset allocation approach, in a blended asset allocation approach, the likelihood of that drop is much lower compared to a pure equity. And as I said, equity is about ability to stay invested for a long period of time. Whichever combination helps you stay invested for a long period of time should be selected.
Fair. This is fairly clear. Vaibhav, a couple of things that I would like to highlight. One, of course, the fact that is mentioned here that choose an asset allocation which allows you to sleep peacefully. This is more behavioral. If you have anxiety over drawdowns, this is, of course, an approach you could take to your portfolio allocation, which is the blended approach. The other could also stem from shorter term liquidity requirements, which means that you're not building your portfolio for the long term, which we've suggested here, upwards of 5 years. And if you possibly could have liquidity requirements in the shorter term, you could potentially use a blended approach where at least money would be available and drawdowns would not be as steep.
No, absolutely. And because we started to believe that equity markets will only give positive returns, a lot of short-term money also started coming in equity markets. So investors should only come in equity market with a time horizon of more than 3 to 5 years.
Uh, Fair. I think that would be it from the questions that we wanted to address in the course of the conversation. I'd like to summarize what we've so far discussed and then open the floor for Q&A. Market corrections are expected, not exceptional. They regularly happen. In fact, double-digit market corrections are very regular. If you've noticed the chart that we presented over the last 20 years, almost every year we saw a double-digit correction. There are positive linings. The long-term story, the macro story of India, from the government balance sheet to corporate and bank balance sheet, as well as more money in the hands of consumer remains intact. Uh, Continue to favor large caps over small and mid caps purely in terms of valuation comfort that we have today. Instead of directly investing in stocks where we've seen that you could potentially see very extreme outcomes, look at an expert who's got expertise to actually evaluate these stocks in detail, in depth, and has experience of running portfolios across multiple market cycles. Realistic market expectations. Market should perhaps give reasonable returns over the longer period. The key is to stay invested, perhaps focus on appropriate asset allocation that lets you sleep peacefully at night and which meets your investment objectives over the short and long term. That's the summary. Those are the key takeaways from our discussion today. I'd like to open the floor for Q&A. Anybody having any question, you can use the Q&A box, which is in your panel, and we would try and address most of the questions. So we'll begin with some of the questions. Weber, one of the questions that I see here is we've mentioned that the interest rate cycle could be on a decline going forward. What are the indicators that inflation is declining? Because monetary policy would be governed by what inflation levels are.
So wholesale inflation has gone down to sub 3% level. Consumer inflation has come closer to 4% levels, and which will give a lot of comfort to the regulators in reducing interest rates. Along with that, we are seeing slowdown in economic growth also. So which should also incentivize regulators to go and reduce interest rates. So these are the factors that we are looking at.
Got it. The other question is the earnings, corporate earning growth has been relatively tepid in the last couple of quarters. While you mentioned that there are positive triggers, when do you see the earnings growth coming back to the kind of returns that we are expected to get in the markets?
So I think this question is important to understand from one lens. What kind of corporate earning will revive? We mentioned that earning recovery will be uneven, and some sectors will see much faster earning recovery compared to other sectors. We believe that banking and financials and consumption-led growth will be much higher compared to investment-led growth going ahead. And therefore, those segments will see faster earning revival compared to some of the other sectors which did well over last 3 to 4 years. So it will be uneven, it won't be uniform. That also means that market will not see a broad-based rally and it will become a more active management market where stock pickers will do much better compared to the broader market.
Where I'd like to address a couple of questions on the macro side. Uh, Few questions around how much window is left for FIs to continue withdrawing. Also, I'd add another question with that, which is around the Indian rupee. Where do you see the Indian rupee going forward, and what could that have as an impact on the market?
So FIs, okay, let's understand why FIs have been selling. So I mentioned that rupee has depreciated by 4.5% in last 3 4 months. Along with that, there is an opportunity cost of 4.5% in US for FIs. So US based FIs can simply invest in US Treasury and generate 4.5% returns without taking any risk. So that's a risk-free rate of return for them. On top of that, there is a currency depreciation risk of 4.5%. So 8.5% becomes the opportunity cost of investing in any emerging market for global investors. So till the time there is no clear visibility on future returns being higher than that, FIs will not feel very comfortable. After this correction, I strongly believe that some segments of the market have started looking very attractive, and the possibility of generating high return in those segments of the market is there. So at least to that extent, FI should start making a comeback. In short term, it may not play out because there are other global factors that play, like aggressive trade policy and other geopolitical issues. But overall, from risk return point of view, few segments of the market have become attractive for global investors to consider now. Now, the second point is depreciation of rupee. Depreciation of rupee overall has been much lower compared to other emerging market currencies, and it's not that bad uh, when we compare it with other currencies. It may continue for some time, but for US also, it's better that their currency doesn't become strong. On one hand, they want to impose strong tariffs to discourage imports. In the same period, if currency continues to appreciate for them, it will nullify some of the positive impact of tariffs that they are imposing on imports. So they would also want a situation where their currency remains stable. So 3 to 6 months is what my sense is, what it will take for currency to also stabilize. Over a long period of time, I don't think US is of the view that they want stronger currency compared to other currencies if they want to reduce their import dependence.
Fair. Uh, Take the next few questions. Vaibhav, question is around timing, I guess. So, given these factors, along with turbulence in AI-driven disruptions and geopolitical events, would you advise investors to enter the market now or take a more cautious approach and wait for better opportunities between, let's say, the next couple of years?
Couple of years, couple of years is a long time. Uh, I think markets, some segment of the markets have become very attractive to enter now. We are looking at all the data after the recent correction, and latest by Monday or Tuesday, we should be able to get back to you with our specific views on entry in the market. Uh, in principle, views that markets have become attractive, especially the large cap segment of the market has become attractive. Can it correct further in short term? The answer obviously is yes. But probability of that, probability of making good money from current levels is very high to let go of.
Got it. Questions around asset allocation. Weber, where do you see gold from here, given we are repeatedly pointing towards geopolitical impacts?
I think gold should be there in the portfolio, 5 to 10%. It should continue to deliver 8 to 10% rupee returns, at least for the foreseeable future.
Fair. Next question is around global investments in markets like US and China. What's your view on looking at diversification geographically as well?
It's important to diversify geographically, especially US market is something that we had spoken about in the last webinar also. Our view is that valuations in US are much higher compared to any other market in the world, and which creates a risk. US represents 70% of total global market cap today, and with an economic contribution of only 27-28%, which is almost making it the most expensive market. We saw a similar thing playing out in Japan in 1989 when started commanding 50% of global market cap. Not saying that US will go through the same pain that Japanese market went through, but clearly means that valuations are excessive, and I would be very careful in allocating any money to US markets now. Chinese markets, on the other hand, there are pockets which are attractive. The the investor who is looking to invest money globally can consider Chinese market over US market.
All this while, Weber, we've spoken about FIIs, but there are reports suggesting reduction in the SIP inflows as well. Would this double the impact? Should we brace for significant impact from here as well?
So again, spoke about recency bias that seems to be kicking in, but that also means that opportunities are there. Valuations have become cheaper, and investors are looking to invest money uh, at lower prices will benefit much more compared to investors who invested at much higher prices.
I see a few questions around asset allocation and what is Dezerv doing to manage different asset allocation across different asset classes. Do you want to address that question?
So we have strategies across asset classes, and our team can you can reach out to our team to discuss your asset allocation needs. It's much more tailor made compared to a specific strategy recommendation. So please feel free to reach out to our team, and they'll be able to guide you on that.
Got it. Question is around I think what Nitin Kamath posted yesterday, that there is a drop in FNO volumes on the exchange. Uh, should the fact that these volumes, in fact, they help to stabilize the market at some point in time, should a drop in volumes also be a matter of concern?
It reduces liquidity in the market, but doesn't necessarily mean that it's negative for the market. If speculative activity goes down, it stabilizes the market also. So there are positives also, which is stability in the price movement will be much higher compared to an environment where speculative activity is very high.
Got it. Vaibhav, you did mention that active management could potentially do better, given that the recovery from here may not be completely wide based, but it could essentially be select stocks moving forward. Question is around how should we go about picking an expert around direct stocks?
I think mutual fund managers have shown over a long period of time that they are the best individuals to pick stocks. So we should select few good mutual fund managers and let them do the stock picking.
Got it. Your view is direct stock
And
investment is
and
also
and
better
we
placed.
can select these mutual fund managers for our investors.
Fair. Uh, There were questions around thematic and focused funds. Because they've already seen significant drawdowns, would it make sense to stay invested, double down? What's your view from here on?
So generally, we have been talking about this, that thematic investing is something that we don't prefer. It creates a constraint for the fund manager to stay invested in that particular theme, regardless of where the valuations are. The other issue with that is these themes become popular only after a large part of the return has come in these themes. So we always encourage investors to stay away from most of the thematic plays. I would still maintain the same stance and say that don't do thematic investing. On focused funds, depends on which focused fund you are invested in. Different focused fund construct their portfolios differently. So there is no one uniform answer to this question. We'll have to look at the underlying portfolio composition of these focused fund. Our wealth monitor covers some of these focused funds and can give specific views on these.
Another question is most of the SIPs or investment is scheduled on particular dates. Uh, when what should the approach be? Especially there are steeper drawdowns on other days. How should investors try to optimize investment on those days?
We did this analysis of daily SIP versus weekly SIP versus fortnightly SIP. Honestly, we did not find any difference in returns. Over 25 years, if you did daily SIP, you did weekly SIP or a fortnightly SIP, there is no difference in the returns. So very difficult to time that. Sometimes markets correct on some Mondays, sometimes market corrects on Friday, sometimes markets correct on Wednesday. So there is no difference in outcome. And if you do daily, weekly, or fortnightly, you may end up investing on any of these days. So outcome has not been different. Basis historical analysis, there is no evidence to support investing in SIP on a particular day.
Got it. Wherever the next question is around what sort of investments can one look at to hedge against the risk of depreciation of the rupee? And
Gold is a
what sort of,
classic
sorry,
hedge against
what,
currency.
what additional, the additional question is what percent of the portfolio allocation should be made to such a segment?
So there are two ways in which you can guard your portfolio against currency risk by investing in non-rupee assets. By non-rupee assets, I mean either you can invest in gold or you can invest in global markets. And global markets, you can do global debt as well as global equity. So 15 to 20% of the portfolio uh, can be in those asset classes.
Vaibhav, typically in the past, and several questions around this because people are anxious about FII outflows. What does it take for them to come back in the Indian markets? I know you covered it in the course, just re-emphasizing.
I think the opportunity or probability of making returns higher than their cost of capital is what they will look at.
Where any specific sectoral preferences? A lot of questions around what sectors could revive first, could revive later, etc.
So domestic sectors will revive faster. Consumption, banking, and financials are two segments of the market which look much better compared to any other segment.
Vaibhav, question around opportunity in silver.
I would stick to gold because honestly, central banks won't buy silver. Central banks would buy gold.
There are a lot of questions. I'll try to cover a few questions before we wrap up for the day. Uh, What is the frequency in which asset allocation needs to be worked out?
So, asset allocation should be recasted in two scenarios. First, if there's any resetting of your investment objectives, which is there, if your cash flow requirement has changed, then you should relook at your asset allocation. And second, likely returns of each asset classes change. So we have had this discussion with many investors that we don't like these labels of conservative investor, aggressive investors, and balanced investors. Investing should be seen in the context of your specific requirements and the opportunity which is available in the market. So both are important lenses and important perspective to consider when you're choosing asset allocation. Once a year, it's good to revisit your asset allocation in these two contexts. And in case any rebalancing is needed, that rebalancing should be done.
This is linked to the previous question on investing in specific days. Can we invest a larger tranche specifically on big drawdown days? I think that's possible, right? Our RMs can manage that.
Yeah,
Is Dezerv considering direct equity? I think. Uh, okay, there was a report, Vaibhav, which suggested that many fund managers have significantly lesser vintage and haven't seen longer periods of investment. Is that a factor in consideration when we build our overall models and portfolios?
very important factor to consider. It's important that you work with fund managers who've gone through various market cycles. They know how to come out of a bad cycle and make the portfolio changes based on the changes in the market environment. We actively look at that in our fund manager selection model. We consider fund managers with a certain vintage and experience who have seen multiple market cycles and know how to navigate through these corrections.
Got it. Uh, does a momentum strategy of rotating capital based on valuations across sectors index give better return than a long-term SIP in the same funds index? I think rebalancing sort of addresses that in a way.
Actually, on the previous question, there is an associated point because there are so many fund managers who launched portfolio management schemes over last 2 3 years with very limited experience of managing money. That is a bit of a red flag for me. And investors who have invested in these PMS strategies, looking at their short period performance, should reconsider their allocation in these strategies. Many of these fund managers have played momentum strategies, and because momentum was strong in the market, these strategies benefited. But these returns are short lived and are facing large corrections. So, that is something that investors should definitely reconsider.
Got it. Vaibhav, in the last discussion, uh, we had mentioned that 40% should be invested now and remaining for the next few months. Is this deployment still valid or should we invest the remaining now instead of waiting?
So, Adi, as I mentioned, we are re-looking at the data today after this week's correction, and maybe by Monday, Tuesday, we'll come back with a specific recommendation on this.
Fair. I have a lot of questions, and I think we are running short of time. I'll try and address as many as possible. Sincere apologies if we've missed any of your questions. You can obviously reach out to your RMs with specific questions, and we would be happy to explain, elaborate further over email, over call as you deem right. Uh, okay, I think you've answered some of these questions. Any view versus private sector and PSUs, given the government has announced that PSUs could potentially disinvest?
I find it difficult to believe in that or play that. Government did not do any active disinvestment when markets were conducive. So in this environment, for them to disinvest large part of their holdings in PSU is difficult. Purely based on that hypothesis, I would not invest money.
Got it. I think most of the questions that I read have been covered in one way or the other. Gold we've covered, silver you gave your view, China, US is covered. Versus the asset allocation that we suggested, which is a blended asset allocation, should investors look at hybrid funds or multi-asset funds?
So you can use hybrid funds or multi-asset funds to create your asset allocation. But as I said, fund selection is one layer below your asset allocation. First, investors need to decide their asset allocation and then look at the funds which meets their asset allocation requirements.
Got it. I take last couple of questions before we wind up for the day. Vaibhav, SEBI recently announced SIF, and there are a couple of questions around this new investment strategy. Any views now, or should we hold back until we have better clarity?
So initial view is that it will help you manage your asset allocation needs much more actively, but we'll wait for some more details to emerge, like taxation, expenses, and everything before taking a conclusive view on that.
Through our multi mutual fund portfolio, which is the PMS that we run, do we also look at international focus mutual funds?
We unfortunately currently all the limits are exhausted. Otherwise, we would love to consider some of these opportunities.
Got it, Vaibhav. Any closing thoughts?
I think few closing thoughts. Corrections are painful, but it also gives you an opportunity. It's painful to see your portfolio go through so much losses and yet take a call to invest further. But that also means that you're buying cheaper. So that is something that we should actively consider. Mid and small cap obsession, I think we need to be much more objective about that. Look at where the valuation opportunity is there. Direct investing is hazardous unless you are investing enough time and resources in understanding each of these companies. And 15% return is a powerful number. We should not underestimate 15% number. So these are some of the thoughts that I had to share.
Great. Thank you, Vaibhav, for such a detailed walkthrough with data and charts, explaining how to behave and what to expect in such volatile times. To the audience, as always, you've been great. Appreciate the participation and questions. For some of you who mentioned your questions were not taken, sincere apologies. We were running short of time. Hopefully, with the discussion that we've had today, you get back to your weekend much clearer about your investment journey. Goodbye and enjoy the rest of your weekend. Thank you so much, guys.
Thank you. Thank you.